All right, so we got to take a look at receivables. Well, first we started off with Chapter 9 with cash. Now we're dealing with Chapter 10.1, where we got to see about receivables. Now this one, it's more or less relatable, maybe not too much, but it does revolve around cash. It's called time value of money, okay? Now, of course, when we look at time value of money, we have to remember that when we're dealing with cash, our currency as of right now has definitely drastically changed in value over time. So that's exactly what time value of money is, right? It's the assumption that we need to adjust money according to the value of it when we consider things such as, hardships, recession, inflation, things like those. Those are going to be contributing factors, especially when the idea of whether the government pushes more money into the system or whether they take money away from the system. So inflation, deflation, same thing, okay? All of those are going to be contributing factors. And the one thing that we know that's if we rely on the US dollar bill to be a stable form of currency, right? We also can assume that, with the given time between, a year from now, right? We can assume or have a safe guess that it shouldn't change that much. But if we're looking at a span of 10, 20 years, then yes, if you go back in 20 years, we can definitely say the dollar has lost its value over time, right? So back then, the dollar, way back when, in the 90s or the 60s, or 60s, 80s, 90s, right? A dollar can go pretty far. Everything was super cheap. Now, fast forward, we're in 2021 now. We could see that the dollar has expanded and multiplied, and everything's expensive right now. Okay? And with everything going on, the government is pushing too much money into the system now. So now there's way too much going on. We're in a recession, depression, if you guys want to look at that. But right now, our dollar value has definitely lost its value over time. And that's the assumption that we're going to be looking at here. So let's go ahead and talk about what time value of money is. Now, this is in perspective of making monetary decisions or measurements. So for this example, what we're going to be looking at is for the business, right? We're going to be taking typical looks at loans or even, bank bonds. All right, so that's the example here. We're not looking at projections of sales or anything like that. I'm going to show you the time value of money formula to be able to predict if you need a loan, would this loan benefit you and how much would it reflect in the future? Or if you guys decided to purchase a bank bond, for your personal decisions, right? Then, this is actually pretty useful, especially if you can determine what it will be in the future versus if you don't invest. Okay, so this is a good, strategy or a good way of looking at how you can multiply your dollar or how you can collect interest. All right, doing both ways, whether you're gaining the money or whether you're planning to do a loan, and how the benefit will help you there. Okay. So first, we're going to be taking a look at two different types of ways that you can calculate time value of money, right? We got first one is called this simple interest. And the other one is, is going to be compounded interest, right? Also known as the complex interest, right? So typically, when we look at simple interest, so the rules behind simple interest is going to be how many times is interest actually multiplied. So in this case, simple interest, the idea here is that you're only going to be charged the interest, right, one time, or calculated interest one time, all right? You're going to grab your lump sum money and you're going to multiply by the interest one time, and boom, that's going to be your simple interest, all right? Now, key factors that are going to be looking into this will be number one is your principal, right? Or also known as your original investment. Second thing you're going to be looking at is what is your interest rate? Now, an interest rate will always be an annual percentage, meaning this is how much they're going to charge you per year unless it's specified, saying this is the interest per month or per 6 months, whatever it is, right? But most case and most often, your interest will always be in terms of an annual rate, okay? And then you have the last key factor here, which is time. Time can be given to in any other way, right? It could be in hours, in days, in weeks, in months. But in this case, our general rule of thumb is if we have an annual interest rate, best way to get your accurate answer would be if you had your time also valued in terms of years, okay? Just so then everything is uniform, right? If you have an annual percentage, you definitely want to calculate your time in according to years, okay? So that's a simple interest. We'll take a look at how to calculate that in a second. But what compound interest does is it's typically the interest rate gets multiplied or it gets calculated more than once. So typical types of compound interest would be any type of credit card, right? If you go get a credit card and they give you an amount and they give you an annual percentage, I can guarantee you they charge interest based on every month, right? So they're calculating the interest every single month. With bank loans, business loans, house loans, some of those can be calculated almost on a daily. I know that car loans are based on every day. It doesn't matter how many days or how many months you owe the payment for, they charge you every day. So you definitely want to make sure that you read all the fine lines, especially when you're dealing with something that you're going to owe and they're going to be calculated based on a compounded interest rate. Now, of course, with that being said, these are the key factors here. Everything's going to look identical to the simple interest except you have one more additional component. You have the number of times compounded, whether it's per year or whatever, right? So in this case, it should be in terms of years. So the number of times it compounds per year is going to be considered your N, okay? So once again, you still have your principal, which is your original investment. You have your interest rate, which is an annual percentage. You have the number of times compounded, meaning how many times is the interest going to be calculated. And then lastly, you have time, which should be generally in terms of years, okay? So let's go ahead and take our first example for the simple interest. So the example here is that, well, first off, let's take a look at the formulas. Now, it's pretty easy, but it's definitely something you don't need to memorize, right? That's why I have the review sheets for a reason. You don't need to memorize this, but it's good to know, especially if you're trying to calculate a specific item. So in this case, the interest that we're looking forward for simple interest is how much interest is going to be collected. So in this case, interest is going to equal your principal times your rate times your time, okay? A mnemonic device could be pretty, right? To solve for simple interest, you think of pretty. PRT equals I, okay? Pretty. And then, of course, when we look at future value is going to be, well, what is my original investment plus the interest that I will collect? And that's going to give you your future value. So FV equals P plus I. So we're looking at that. So when we look at a bond, we're going to determine, well, how much is it going to be in the future? Okay. So once again, let's go ahead and apply it to this scenario. So, of course, the example here is that you decided to buy a bank bond, okay, from the bank. which you purchased it for a total of $100,000. Okay, the interest rate is 6%, and it could be collectible, or you could redeem it in 5 years. So the one thing about bank bonds is that it's considered a security, right? The one thing that you can't do is you can't pull out your money any given time. If you buy a bank bond and it's set to be for 5 years, you can only redeem it after the 5 years. Now, will you keep continuing collecting interest? I don't have a clue, because if you just bought a bank bond for 5 years, then by the 5th year, your bank bond should have matured and it should be available for you to collect at any given time. Usually that's the rule. I don't know if they changed it anytime between now and whenever the last time, who buy banks bonds. Not very common. Okay, but let's take a look at this. So P, R, and T. We need to know those 3 key components. So what is my principal? 100,000. What's my rate? 6%. So in this case, when we're calculating multiplications, we always need to consider our percentage in terms of decimals. So in this case, it'd be 0.06. And lastly, what's my time?
5 years.
5 years. So once again, when we look at a percentage, we need to convert it in decimals, because that's how we be able to multiply. Okay? So let's go ahead and solve for our interest, which is our PRT equals I. So we're going to take our principal, we're going to times it by the rate of 0.06, and we're going to multiply it by 5 years, because this is already in terms of years. So how much should be my interest?
$6,000.
Try again. That's all. You only completed P times R.
Times the 5.
Times the 5. So remember, you needed to use all 3 components. Plug them into the formula. P, which is 100,000, times the 0.06, times by the 5 should give you 30,000, right? Okay? Now the next thing is, well, how do I determine how much that's going to be in 5 years from now? So let's solve for your future value. Future value is your principal plus your interest. So in this case, what is my total future value on this bank bond?
130,000.
130,000. So of course, so this is why we can make this projection. Is that worth it? Is it worth it to just collect only $30,000 in a span of 5 years? Probably not. The average person that works is roughly anywhere from $20,000 to $30,000 per year. So if you have to wait 5 years to collect $30,000, then I wouldn't say the bank bond is worth it. Now, most cases, the reason why bank bonds don't give you such high interest rates is because it is secure, right? It's dealing with your bank bond itself. There's limited amount of risk that you would take when you're dealing with a bank bond. But if you're going to be something like stocks, that's a little more dangerous, because, you don't know what the risk is. It could be 100%, it could be 50%, it could change every day. So in this case, you can't use this for stocks. It's not going to work. And yeah, but you can make a progressive, prediction, okay, if you'd like. But in this case, you wouldn't be able to apply it. And most bank bonds are just going to give you not that much percentage in regards to your earnings, your interest that you could collect. Okay, so that's the first example. Is everyone okay with this one? Pretty straightforward. It's simple. It's easy.
Yeah,
Okay.
I'm good.
Okay. So now we're going to be moving on to compound interest. Now, compound interest, also known as the complex one, right? You do need to use Excel in order for you to calculate this. Okay? Excel, or a very expensive graphic calculator. You can't do this on a regular calculator. Okay? But because you guys should all have Excel, you guys should have no problem doing this. Okay? So if you don't have that expensive calculator, which costs about $100, right? If you know what I'm talking about, the 89 Ti or any of those graphic calculators that allow you to do functions and all that, like extra symbols and stuff, that's what I'm talking about. In this case, you guys all have access to Excel, so you guys should be able to do this pretty straightforward, pretty easy. Now, let me go ahead and just talk to you what the equation is, and then I'm going to show you the Excel version, because Excel, you have to be very, very careful on where you place your parentheses and where you place your numbers, okay? So, but for this one, let's talk about the equation in the first place. Compound interest, right? We've already talked about a brief description, right? It's basically you're going to be calculating interest based on how many times it's being calculated, okay? So here, the formula here for interest is going to be your future value minus your principal. Okay, so therefore you need to solve for your future value first in order to solve for your interest. So what is future value? Future value is going to be this complicated formula right here. It's going to be your principal times parentheses 1 plus your rate divided by the number of times you're going to be compounded it by, close parentheses, then you're going to exponent, all right, or times to the number of times you're compounding it times time up to the exponent. I don't know how to say that. But down here, it shows you exactly how it looks. So in this case,
For our project?
in our project, no. But we will do this for our exercise, yes. Okay, so once again, the formula is down here. The equation is down below, right? If you want to look for I, it's going to be your future value minus your principal, okay? But your future value is going to be P, parentheses, 1 plus R over N, close parentheses, N T to the power. Okay? So in Excel terms, this is what it's going to be, right? So let's do the example this time, and I'll show you what I mean by the Excel version. So first things first is you bought another bank bond for the $100,000. Your interest rate is 6%, but here's the thing. You're going to be compounded quarterly, all right? And it can be redeemed in 5 years. So this time, what are my variables? So in this case, what's my principal?
Still 100,000, right?
Mm-hmm. What's my rate?
0.06.
0.06. What about my number times compounded?
Quarterly would be 4.
Quarterly would be 4. And lastly, time? 5. Excellent. So there you go. All of that. Now here, let's solve for a future value. So this is where I'm going to show you how you plug it into your Excel worksheet. So again, future value, obviously you can start with your equal sign. Now how you have to tell Excel is you need to let Excel know that you need to calculate certain amounts first before you can be able to do this. So in this case, the formula is going to be your P with your asterisk to represent your multiply, open parentheses, 1 plus another open parentheses, your R divided by N, double close parentheses. You need to have that, or else your formula will not work. You need to do the caret sign. The caret sign is going to be the key, your shift 6 is your caret, I think. Let's take a look.
Is this, was this formula put on the study materials that you gave us a couple weeks back?
study materials that we gave you a couple weeks back. What do you mean by that? On the review sheets?
Yeah, the study material that you gave us a couple weeks back that had all the different formulas on it.
Yes, this is on it.
What, okay.
Okay. All right. Open parentheses, N times T. Close parentheses. Okay. So this is the formula you are going to be using in Excel. Okay. Now, of course, this is just the example here. I'm only going to show you this, and then when we move on to our worksheet, that's when we'll go ahead and produce this, okay? So here, I plugged in 100,000 times the 1 plus the 0.6 divided by 4 caret 4 times 5 to equal a total, of 134,685.50. Okay, so in this case, if it's compounded every quarterly, right? Every 3 months, it gets calculated with interest. So therefore, at the end of 5 years, this is what it's going to come up to be. It's going to be 134,685.50. So therefore, how do we actually know how much interest we're going to be collecting? What's my interest? Correct. So looking at this, we'll also take a look when we do the exercise. We're going to compare and contrast because I'm going to compare the simple interest versus the compound interest. Which one's better? It really depends, okay? It really depends on how many times you're being compounded for. But once again, just because you're being compounded it more times, that doesn't necessarily mean you will produce more money. Okay, and like I said, we'll take a look at that in the exercise after this. So once again, in this case, in this very specific scenario, I earned actually $4,000 more than if I did the simple interest. Okay, but still, $34,000 for in a span of 5 years, it's probably not worth it. Okay. But again, if you're looking into like a bank bond for retirement, this will definitely be worth it. If you don't want to touch your money for 5 years, this will definitely be worth it because that's a whole work year that you earned without doing anything, right? So once again, it just depends on the scenario, what kind of cases that you're looking at, but this is definitely useful, especially when you're considering either opening a credit card or even applying for a business loan, or even if it applies to personal, right? If it's worth it to take, a mortgage or take a loan to borrow money so you can buy a home. That is definitely something you definitely want to calculate and consider or even buying a car, okay? It's definitely worth taking a look at. And it's amazing what you can do with this formula. Okay? So with that being said, that's compounded interest. Any questions?
Looks a little tricky, but I guess we won't know until we put it in the exercises.
Okay, yes. So I think... Okay, so whoops, that was a scratch piece right there. So again, when we actually look at journalizing this, right, when we journalize it, what's going to happen is you're going to be collecting either a bank security, right? You purchase the bank security, right? And obviously you're going to spend money to buy the bank security, right? And then fast forward when you actually are looking at calculating or when 5 years come across, what you're going to do is you're going to redeem your bank bond, right? Checking. It was valued at $100,000, so that will always stay there. But one thing that you're going to also include is now you've collected interest income. Okay? This is just extra stuff. I don't expect you guys to know this stuff particularly, but this is very useful, especially when you're deciding that you want to buy a bank bond. So if you're going to buy the bank bond, you obviously have to purchase it. So you're going to be taking $100,000 in the first place to debit your bank securities. So bank securities is also another term for bank bond. Okay, it's money that you own. Okay, and then of course when you redeem it, you're going to obviously collect the cash from it. You're going to zero out your bank securities, and you're going to collect interest income off of that bank bond. So that's just that right there. Okay. So other than that, compounded interest. So a perfect example of a compound interest is, this is definitely something that you should actually know. So when we're dealing with compound interest, how it is actually calculated. So when we take a look at looking at our compound interest earlier, right? We were only looking at a projection, right? If we buy this bank bond in the future, how is it going to look like? Now, in real life, this is how a interest is actually collected on a loan. Okay, so this is a real life scenario where you're more likely to commonly use this more so versus a simple interest. So for those who don't really understand where this extra money is coming from, we can go ahead and take that scenario and we're going to expand it so you can see on a day-to-day basis, on a month basis, or whenever you feel is necessary, or how you making a payment to your loan, you actually, if you guys actually, work in a bank, you would actually know that your payment actually goes towards your interest first, and then whatever extra money is there will go actually towards your actual principal. So that's why if you've ever heard of that Rule 22 or something like that, where at the end of the day, you're basically paying your interest that you've collected on your bank bond is already pre-calculated. It's already included into your bank bond without you knowing it. And every payment that you make, it pays off the interest, and anything remaining will pay off the actual original loan. Now, with that being said, that is exactly why a lot of people who decide to go get those credit cards or go dive into those bank loans takes them forever to actually pay off what they actually owe, and they actually end up, collecting more interest or having to pay off so much interest than actually paying off their actual loan. So this is why I think this is very, very important, because it can apply to anything that you do in the future, whether it is buying a car, right? How much interest are you actually paying? Now, the best rule of thumb here is if you make multiple payments on your loan, then obviously you pay off your loan a lot more quicker. But some people, they can't afford that, right? Same thing. That's why all credit cards, right? They give you a minimum. Why? Because that minimum covers the interest. But are you actually paying off the credit card? No, you're not, unless you pay above the minimum. Now, don't think $5 is actually going to make a dent in your loan. You should actually consider dumping at least 4 times the minimum, okay? So with that being said, I'm going to show you how you actually calculate an interest on a loan. So first things first is we're going to recognize on January 5th, right? You decided to borrow a bank loan for, $10,000, okay? And it has an interest of 4.75% APR. Once again, that is annual percentage rate, okay? And then, of course, you are expected to pay it off, right? You have a time on it. It's supposed to be 5 years. And, of course, it's most loans, if not, depending on how you disclose it, most bank bonds, they compound you every month. So that's 12 times a year, right? And it's usually based off of your account balance, right? Or the amount that you still owe. So in this case, let's go ahead and take a look at this. So so on January 5th, I decided to get this bank bond. So how am I going to record it bank loan. So in my journal, how am I going to record it? How am I going to record that I decided to just get a bank loan?
Would it just be a loan or
Yes,
account?
loans, because what is loans?
I would say credit.
It is a credit.
Okay.
Why?
I'm just guessing. Oh man.
You got it right.
You probably wrote a check, so I would say debit checking.
Okay, we're not buying. We borrowed money. So therefore,
Oh, yeah, that's what. Oh, okay.
so remember, sorry, I think I confused you guys because I said bank bond. No, this is a bank loan. We're borrowing money. So therefore, what should we get in return if we borrowed money?
A credit line.
Okay, but we borrowed the money.
You get cash or a check.
Absolutely. You get the money for in place of a bank loan. So again, usually typically bank loans, it's not a credit line. You get the whole money, right? You get the whole amount. Okay? So if I borrowed $10,000 for the bank, right? Therefore, I have $10,000 in my checking account. Okay? And therefore, but I have to pay the bank back, right? On their terms, right? So they may have to send me a bill every month. That's fine. So here, we're just going to recognize that we just got the bank loan. Now, question is, when do we accrue interest? Monthly, right? But I just got the bank loan. Shouldn't I be accruing my interest?
Does that usually start
This is, okay, so in this
days
case,
after you get the loan?
correct. 30 days after you get the loan. So in this case, I'm just recognizing that I actually received the lump sum amount of $10,000. Okay. Now here's what the table should generally look like. You're gonna start off with your interest or your principal, right? And every month that passes by, right? So right here, the first month of January, you're gonna accrue 0% interest because you just got the bank loan. It won't accrue until 30 days after you receive the loan. So in this case, I got 0% right now. I got 0 interest, and my current balance is still reflecting as $10,000. I have 0 interest. Once again, I never made a payment yet. I just got the loan. So therefore, my new balance is still going to be $10,000. Okay? Now let's go ahead and move on to month number 2. Okay? So now, hold on. The bank approves the loan and expects to be paid back in 5 years. Okay, so then again, the bank, so the bank sends you a bill, right? And your payment says you have to make monthly payments of $187.57, and it's due on every 5th of the month. So in this case, this amount right here, right? If you use your Excel, one of the things that you should learn in accounting is how to use the payment function key. I'm not going to teach you that because that's way advanced. But by typing that in and solving for the payment, you need to make at least $187 monthly payments to pay for both the interest and to also pay for your actual loan. So in this case, since I received a bill, I know that I just have to pay $187.57. So let's go ahead and calculate this here. So it's February. Our account balance is still $10,000. However, we didn't calculate for the rate or the interest yet. So in this case, what's my percentage again? What was the percentage of my interest?
4.75.
Now that is an annual rate. We're doing monthly payments. So in this case, how much interest should I actually be charging? Or in this case, calculating?
Would you divide the APR by 12?
Correct. Because once again, this is an annual rate. That means that's how much you're going to collect or how much you're going to be calculated in 1 year. So because I'm doing monthly payments and it's being compounded every month, I need to divide this amount by 12 to give me my monthly amount of interest that I'm going to be collecting. So pretty straightforward, right? You take your principal, you times your interest, and how much should you actually get for your interest?
0.003958.
Okay, so that's to calculate the rate, right? You're taking your 475 and you're dividing it by 12. Now my question is, what is my interest? Okay, good. You multiply your principal to get your monthly interest of $39.58. Okay, so therefore, your current balance is now going to reflect as $10,039.58. Okay, so now we need to decide to make the payment. Okay, so if I decide to make my payment of 187, right? That's what the recommended or billing statement told me that I need to pay. So in that case, I decided to, okay, let's try it for the first time. If I paid the exact amount, I wrote a check for this amount, okay? Right? Therefore, how much is actually going towards your principal versus actually how much is going towards your interest? So that's where we're going to start calculating this, okay? This is where we journalize it. We made a payment, okay? We're going to make a payment to the bank loan. Now, we need to also recognize interest expense because a portion of that money isn't going towards the loan. How much is actually going to the loan? So if we calculated that 39 and 58 cents is the actual interest, right? Therefore, this is how you're going to do it. You're going to recognize that you're going to pay the full amount of the $187.57, right? And because we calculated the interest to be 39.58, you're paying 39.58 to interest, and the actual amount that's going towards your actual bank loan is only $147.99. Okay, so this is very, 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 very useful, especially if you are considering, taking any loan out. You need to know the interest is already pre-calculated. There's no, if I pay more, then the interest will be less. No. That's actually true if you're trying to pay off, then yes, you will get charged less interest because you have less time for it to accumulate. However, you do need to go ahead and tell the bank that I want this money or this next payment to go towards my principal. Then you can avoid having to make that extra payment to the interest and actually pay off your loan. Okay? So, from the previous example up here, right? We recognize that when we made the payment of $187.57, right? Now my new bank or my new balance should be $9,852.01. Now that's including the interest, right? That included the $39.58. So once again, no matter where you're at, your very first payment's going to go directly to paying off the interest first. And then the rest goes to your principal. So that's just a key thing that you should know. You can never get away around it. If you decided to borrow money, you're 100% gonna have to make payments to the actual interest. So once again, here's another example. I kind of want to move on to the example, but if we continue on, right? I bring my current balance of my $9,852.01. I multiply it again by the rate to get another additional $39 now added to my current balance. And now, if I make that payment once again for the $87.57, this is what's gonna happen. I'm actually paying $39 to my interest, and the rest is going to be paying towards the actual principal. So if you just continue to make your same exact payments, what are you essentially doing? You basically paid all of your interest. It's already pre-calculated. There's no way of going around it. If you make that same exact payment for every single month for the next 5 years, you will end up paying a huge chunk of the interest, and then you'll be paying off your principal. And that's how a lot of the credit card companies, debt collectors, bank loans, anything that does a loan, that's how they get their money, because they think that whoever is borrowing the money doesn't know that when they make a payment, they're paying the interest first, and they can care less. So just a little rule of thumb, a little, food for your thought. The next time you actually take a look at looking into a loan, consider making a larger payment than above the minimum to reduce the interest that you're going to be charged, but also to clear up your debt a lot quicker. And if you're making multiple payments, consider calling the bank and say, I want my second payment to go directly towards my principal. Then you avoid having to pay that extra interest for whatever day that you do make your second payment. Okay?
I have a question.
Go for it.
I thought when you had a bank loan that it was automatic that a percentage of the minimum payment went to interest and a percent of it went to principal.
It is. That's exactly what I just explained. Yes. Now, you think that, but in reality, that's not true. They may tell you that just to cover their butts, right? Oh, yeah, the minimum payment, right? If you paid me $25 a month, right? Oh, I'll make sure I'll split $12.50 to the interest, and $12.50 will go to your principal. No. You always, it's already pre-calculated, and that's why they give you that bank statement. They said, okay, well, here is your bill. If you pay, right? If you are making that, loan, right? They're expecting you to finish the whole entire payment by 5 months. So what they did is they just took the principal, they multiplied it by the rate, they did the compounded interest, and what they did there is they already calculated how much interest you're going to be paying for the loan, divided by the number of payments that you had. So whatever 5 times 12 is. So over the span of 60 payments, they've already did the calculation for you. But they don't tell you that. They just send you a bill and be like, here you go. This is the interest that you were charged. There you go. All you have to do is write a check there. No one really reads the fine print. And unfortunately, that's the sad reality.
See, this is what I didn't understand. My next door neighbor went to the bank and she got an equity loan for $95,000. And every month she made the minimum payment, which I think was like around, say, $500.
Okay.
And she said to me one day, she says, I don't understand this because I've been paying on this loan for 10 years now, $500 a month. She says, I've paid over $60,000. And I borrowed $95,000, and my balance is $95,050. So she said, where'd that $60,000 go that I've been paying the last 10 years?
Exactly. And you
None of it went to
always,
principal.
exactly. And that's how they get you. They get their money first by collecting interest from you first. And then everything else goes to the principal.
See, I always thought a percentage, no matter what, that part of the payment automatically went to interest and part of it automatically went to principal.
Nope.
I guess in her case, it didn't.
Nope. And that's where they get you. And that's why I want to let you guys know this is also food for your thought. Next time you guys decide to go into a loan, consider these factors. And that's why I wanted to teach you this, so then maybe one day, if you ever do consider to get a loan, calculate it yourself. How much would it cost you? How much interest are you actually going to be paying if the rate is this and you decide to extend your loan for X amount of years? Okay, so the longer that you pay, I believe the higher the interest for the longer that you pay. The shorter the interest, the shorter amounts that you pay. I believe that's how it works. But obviously, who's going to have $500 to pay every single month or $800? I think if you do what is it, 3-year loan on $20,000, who's going to have $800 to pay every month? Exactly. Go ahead.
My house payment many years ago was about $800 a month,
Okay.
and only like $253 went towards the principal. Everything else was interest.
Correct. And that's why bank loans are property loans are the most dangerous ones, because those accrue on a daily. They don't accrue on the month. They do it every day. So even if you paid on the 14th, you're going to get accrued the interest on the 14th day, up to the 14th day. So that's why equity loans or home loans, they're a little more extensive, but that's just the reality of what you do when you go into a loan. And trying to educate you guys, if you guys don't know, financially, your safest bet is not to borrow money at all. But in this case, who knows, right? In their given situations, it's probably what is necessary. So I just wanted to educate the reality and what actually happens. When you actually make your payments and you pay the minimum, you're actually paying off the interest first, and then whatever remaining goes straight to your principal. So in this case, you're never going to pay your principal off, and that's why you're always going to be looking at your bill saying, where is my money going? It's going straight to the pockets of the bank. Okay?
But how come when I make like a car payment or a house payment and I pay, whatever payments due that month, part of it goes to interest, part of it goes to principal.
All right.
In her case, it all went to interest.
Could have been interest first and a rate of interest.
That's,
I don't know.
yeah,
I don't know.
that could be
So
true
it hasn't
too.
been worded that way. But I just felt bad for her because it's like she just paid $60,000 on a $95,000 loan.
And it went
Still owes
straight.
$95,050.
Yeah.
She owes more than what she borrowed after paying $60,000.
Yeah, so it may also be, it may be the person that she borrowed the money from. So, again, there's a lot of different loans. And again, sometimes it's true. We don't actually read the fine print. It could be that they said that, okay, well, if you're going to borrow $95,000, just know that you signed this contract. I'm going to have you pay all the interest first, and then you can pay off your principal. So that's why I was kind of saying, when you do go into those kind of loans, and you want to pay off your principal as soon as possible, and you're making double payments, you want to ensure that your double payment is actually going towards your principal. You never want to just pay them off because the first thing that they're going to do is, oh, it's money. I'm going to go ahead and pocket that for my interest. So you definitely want to be very, very specific on where your money goes, especially if you're making multiple payments. You never want to make multiple payments just because you think that's going to reduce your minimum payment or your interest. No, you have to make it set clear. Now, it's going to be a little more difficult for credit card companies, obviously, because they're not bank related. So anything that you're doing through the bank is where you can have the leverage to do that. But, regular credit card companies, right, debt collectors, they don't care. They care about you paying them and paying their interest. They don't care about you lowering your debt. So the best rule of thumb is if you do go into those kind of credit card services or anything like that, just pay the whole thing off. Even if you can't, at least try to pay a good portion off, because if you just continue just paying the minimum, you'll never see your principal ever drop down. Okay?
She was charged like 63% interest.
60. Okay, so it in that case, hold on, that's I'm gonna have to ask you to hold on to that. And let's do the exercises, and maybe we can talk about that later on.
Okay.
Okay. So once again, here we are with our chapter 10.2 exercises, the time value of money. So once again, this is only on an Excel form just because you won't be able to do the future value for the compounded interest formula. If you don't have that, once again, you can't use a regular calculator to do that. You must either use Excel or a graphic calculator. But let's go ahead and go through the examples one at a time. Okay, so question number 1. Okay. I gave you the formulas right at top, so, you're welcome. All right, so number 1 says that you bought a bank bond that's worth $500. Okay, so $225,000 fit $500,000. I can't even say that, but you got it. Okay, and the simple interest rate is going to be 7.45%. Okay, and it can be redeemable after 3 years. So how much is the interest worth, or how much you're going to collect at the end of the 3 years? So in this case, we're going to be trying to solve for the simple interest, but we're also going to be solving for the future value. So once again, what is going to be my formula to solve for my interest?
Interest itself, it's going to be principal again times rate times time,
Mm-hmm.
which is 50,333.25 cents.
Okay, so times 0.745 times 3 years. Okay, so my years are in years. So therefore, you got the 50, yes. Okay. So how much is going to be your total future value in 3 years?
275, 899 and 20 cents and 25 cents.
Yes, so here, let me extend my window here to show those 25 cents. Okay. So boom, pretty straightforward. It's pretty easy, right? You're only getting the interest charged once, so they just do it at the end of the year, right? Because you have a bank bond, they're not going to calculate it every month. You can figure out how much it is every month by taking this and dividing it by 36, because you have it for 3 years, and you can see how much interest you collect every day. But in this case, it's a straightforward lump sum. You're going to take the lump sum, you're going to multiply it by the rate, and you're going to multiply it by the time it's going to take you to collect, and then boom. So the answer is the $27,899.25 for the future
See
value.
that formula again
Which one?
for the future value?
Future value. It's just your principal plus your interest. Yep. Straightforward. So right above here. So in this case, I'm using straight, what do you call it? Simple math. That's all I'm doing. So in this case, I just typed it out so you guys can see it. Okay. And boom. There you go. All right. So then question number 2 is just pretty much a nice table here to just go ahead and give you just quick examples. So once again, let's solve for the interest and let's solve for the future values for all 3. So interest, okay, if I had a principal of $15,000 at a rate of 5.12%, okay, for 5 years, what is going to be my interest?
7680. 76,800. Oh,
Try that again. Let's do that again. Let me make sure I didn't typo something. So 15,123 times 0.52 512
I see what I did.
times 5.
I went 5.12.
Oh, you actually multiply by 50%. Okay, so what is your interest here?
40?
3840. Yep. And then future value is going to be your interest plus your principal. Yes. What? I did not do that right. I think I multiplied it by accident. Okay, so this plus, oh yeah, I did. I multiplied it by accident. Okay, there you go. 18,840. All right. Now let's go ahead and do the second one. Okay, so the second one says my principal is going to be 4,521.50. My interest rate is 2.45%, and this time my time is in 90 days. So what do we do here?
How would we do the 90 days for the time?
Well,
I got $1.23.
that is not right.
Okay.
Okay, so let's take a look at 90 days. Okay, what is 90 days considered?
3 months.
3 months. Good job. So we know that 30 days, right, equals 1 month, right? Okay. And then how many months are in a year?
12.
We got 12 months equal 1 year. So 12 months equal 1 year. So in this case, we need to convert in time this 90 days into years. So if you have 90 days, which equals 3 months, okay? And there's a total of 12 months. So how much is it per year? What is 3 months out good, right? 3 out of 12 equals 1/4. Yep, 0.25. Okay, so that means you're only getting charged the interest for just a quarter of the year. So let's calculate that. 2769. Yes, good. That's actually correct. So there you go. Boom. We're going to multiply that by the 245 times 0.25, which should be the 20. Oh, I should equal round that, just so then it gives me a nice number. Equal round 452,150 times the 0.245, right, times 0.25, comma 2. All right, so I get 2769. Is that what you said, Nicole? Okay, 27 plus 60, 2769 plus the 4,521. Oh, I multiplied again. Okay, so you should get a total of 45, 49, 19. All right. All right, let's do the last but not least. This one here. So we have 384,125.22 at 7.89% for 6 months.
$4,705.54. Well, I got 53 cents, but I'm rounding up.
Okay, no, I didn't get that. Hold on. You said 4,000?
I said $4,705.53. Well, I got 53.394.
I still didn't get that.
153.
I'm messing up.
15,000. That's what I got first, but let's try that again. Okay, so equal round. Okay, we're gonna take my 384 125 22, right? 384 125 22. We're gonna multiply that by the 7.89%, so 0.78. Multiply that by 50% because we're only dealing with 6 months, comma 2. Yeah, there you go, 15. Perfect. Yeah. Then we're going to add that to my principal, and what should we get?
399,278.96 cents.
Good. All right. So once again, this is the easiest one. You could do this with a regular calculator. You just punch those numbers together. Okay. All right. Let's see what question 3 is. So question 3 says that we're dealing with a compound interest, okay? So here's the formula above. So we're going to practice this together, okay? So in this case, question 3 says that you were approved for a bank loan for $5,500, okay? The interest rate on this is going to be 6.25%, all right? And it is compounded monthly, right? As typical, right? How much interest will be collected if you decided to pay it off in 5 years? So here we have our components here. We have our principal, we have our interest, we have the number of times compounded, right? Every month is 12. And last but not least, we have 5 years. So let's practice this formula, okay, for our future value. So once again, it's going to be your principal, okay?
The double parentheses you said?
You need to have the double parentheses, but remember, so it's the principal times your first parenthesis, 1 plus your second parentheses, your rate, divided by the number of times compounded, double parentheses, caret, open parentheses, your number times compounded times time, okay? And that should be your formula. So exactly how I have it displayed above in this worksheet. That's what you need to do. So you want to be very precise, right? So it's going to be P times P times open parentheses, 1 plus open parentheses, R divided by N, close 2 parentheses, caret, open parentheses, N times T, close parentheses. And you have to have that ending close parentheses or else it won't work. Okay? So what did you get for your future value?
I can. My time is 18. $7,511.51.
7, 5, 11, 51. Good. All right. So again, we'll do it again in the next example. So in this case, how much interest did I actually collect?
$1,011.51.
Yes, 2,000. Okay. So it has to be future value. I did that wrong. Future value minus your principal should give you 2,011.51 cents. Good. All right. So let's go ahead and go to question number 4 here. So once again, let's go ahead and compute this and let's compare between the simple versus the compounded. So for future value, let's go ahead and practice that whole thing up there. So once again, if I had $15,000 principal at 5.12% rate, compounded 4 times, for 5 years. So how much is going to be my future value? So once again, let's practice it. So it's going to be 15,000, right? Times, open parentheses, 1 plus, open parentheses, your rate of 0.52, 0.512. Divide that whole thing by 4. Close parentheses, close parentheses. Hold shift for your 6, for your caret. Then open your parentheses one more. Then you're going to take your 4 and you're going to multiply it by 5. Because that's how many time is. And then close your parentheses. So in this case, what's my future value?
$4,125.25. I messed up somewhere.
Okay, you said 4,000, right? That's your interest.
Oh, okay.
That's your interest.
Oh,
My
go-
formula is not coming up
Okay.
as a value.
I'm doing something wrong. Hold up.
Did you sub-reference the time, because there's actual letters in there, so you can't really reference that cell in case.
Oh,
Yeah, you actually have to type in 5.
I think that's what's happening in my numbers.
Yep. Well, you got the interest correct though. You said 4,000.
No, even the interest was kind of correct, but not quite correct at all.
Okay.
Yeah.
Okay. So then let's go ahead and do the second one then. So then maybe we can find it better.
So we could try to get the first one.
Yeah. That's what I meant. Like let's look at your formula one more time. So what did you do? You did the 15,000 times.
And open parentheses,
Mhm.
1 plus the rate.
Open parentheses. You're missing that one right there.
Yeah, the open. Oh, yep. Open parentheses, C8 divided by close, open, close, 19,344.84.
Correct. Okay. Now, of course, you can use Excel's functions, but once again, you're going to be off by a lot if you use Excel functions, just because they're not looking at what we're doing, right? In their future value, it's going to be primarily simple interest. So you want to be very careful on using the Excel formulas or functions, because they're not going to teach you this one. This one you have to calculate on your own. Okay. All right, so we got that right. And your interest is that you've collected in 5 years is going to be
The time would be the 0.25, right?
time is 5 years. 0.52512 is your interest rate.
I'm working on the second one.
Oh, sorry. The what did you say? What was your question? Oh, yes, 0.25. Yes.
Would be 45.49 and 11 cents.
Okay, hold on. 40, let me go 45. So let me see, my principal times 1 plus, open parentheses, 0.24 divided by 2, close, caret, open, 2 times 0.25. 4, 5, 4, 9, 11. Is that what you said? All right, then you take your future value minus your principal. So what's your interest that you collected here?
$27.61.
27.61. Okay. And then last but not least, so let's do it one more time. So equal. What's your principal?
384,124.
Times, open parentheses, 1 plus, open parentheses, your R, your rate, so which is your 0.789. You're going to divide it by your N of 3. Close parentheses, shift 6, which is your caret. Open up your parentheses, and it's going to be 3 times 0.5 because it's half a year, right? 6 months is half a year, so 0.5. What's your...
99,378.16.
Good. So therefore, what is your total interest that you're going to be collecting? $13. I got 15.
No, I said 15.
Okay, 15,25294. Okay. So let's go ahead and compare and contrast our question number 2 versus our question number 4. So if we were to do a simple interest being charged only once, let's look at the interest that we would collect. So we got $3,840 for the first one, $27.69 for the second one, and then we also had 15,000 $153.74 for the last one. And let's compare question number 4. How much interest did we actually collect for this one? So in this case, my first one, I collected $1,000 more. Okay, I went from 38.40, right, where if I compounded it 4 times, I would have gotten an extra additional 4,344. Okay, whereas the second one here, we only got $27.61. Whereas if I did a simple interest, I got $27.69. Now I only did better by 8 cents. So in this case, does it really matter? Not in this case. All right, where we look at the last one, right? If we were only compounded 1 time, I only earned $15,153. Whereas if I was compounded at least 3 times, so every 4 months, I actually earned about maybe $100 more. So I got $15,152.94. So which one works better for you? It really doesn't matter, but I can tell you right now, if you are going to be doing this, most likely in any cases, you're more likely to be compounded depending on what you're buying. Now, I've never heard of a bank bond that can actually be compounded. That's pretty rare because they don't really want you to make off that much money. But in this kind of case, if you're comparing, contrasting, what's better? Would it be better to be times once, or would it be better to be times the interest multiple times? It really depends on how much your money is. Okay. So excellent work. So last but not least, we got question number 5. So I'm going to have you guys practice this real quick. So, yeah. So in this case, we're going to go ahead and take a look at this scenario here, we're going to actually calculate the interest ourselves so we can kind of figure out how much we actually pay towards our interest versus how much is paying towards our actual principal. So in this case, we're going to go ahead and number 5 says journalize this bank loan, okay, from example number 3. So from example number 3, right? We took a look and we borrowed a bank loan for $5,500. The interest rate was 6.25%. It's compounded every month, and we're going to collect it, we're going to pay it off in 5 years. So in this case, let's go ahead and take a look at this. So if I borrowed the bank loan, okay, so it says right here, the interest and payments are variable, obviously, due every first of the month. And in this case, there are no hidden fees and absolutely no interest, 0 APR at any given cause. So that means we're going to be charged interest immediately as soon as we, they don't give us a grace period. That's what that 0 APR is. So no hidden fees and no 0 APR on the bank loan. So that means it's going to be effective immediately. So with that being said, let's go ahead and journalize the first 3 payments. But first, we got to journalize us actually receiving this bank loan. Okay, so on June 1st, okay, if we just borrowed the bank loan on June 1st, what is going to be my journal?
You wouldn't have a payment due till July.
You wouldn't have a payment due in July, but we still have to journalize that we receive, yes. But we still have to journalize that we received the bank loan in the first place. Make sense? That's what I'm asking you. We need to journalize us receiving the bank loan first.
Checking for debit and bank loan for credit.
Good. So checking comes first, right? We're recognizing that we're receiving the money. We need to format this too. So you guys are following along. Format this, please. It's supposed to be left aligned. Okay, so we got the checking, and we have the bank loan. Right? Once again, interest, is it going to be charged?
Not yet.
Not yet. So my checking account is going to be for the 5500. Okay, it's going to be for that amount. Okay. Now let's go ahead and take a look at our top line here. Okay, so in order for us to know how much we're going to be calculating the interest off for July, what was our interest rate?
6.25.
Okay, if I'm doing this on a month-to-month basis, how much is going to be my interest rate now per month?
We divide it by 12.
Yes, it's 0.625, right? Let's see.
Is it
Interest?
0.00520833?
Yeah, the interest is 0.625, right? We're going to divide it by 12 to give us our total rate per month because it's going to be compounded every month, right? So we need to be able to solve for how much interest are we collecting on a month-to-month basis. So what did you say, Felipe?
That's what I got. Yeah.
Okay, perfect. So then, what is going to be my monthly interest for the month of June, right? Because we're making the payment as of July. So we need to accrue for the month of June. So in this case, what is going to be my total here? So use your equal round because we want nice even numbers. How am I going to solve for my monthly interest?
Times 1.
Go ahead, what was that?
Your balance times the rate equals your monthly interest.
Good. So what was my monthly interest for the month of June?
$42.01. I messed up somewhere. I gotta fix it.
Okay, let me do that too because I think you were correct on that. So equal round. We're
I
gonna
got
do
2865 as well.
times this, comma, 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 2. Okay, so 2865. All right. So then, what is my, in this case, current balance?
$228.65.
228. Where did you get 228?
Oh, I added the interest to the, oh, wait.
You teaching?
I added the interest to the payment. That's wrong.
Okay. All right. So no, we don't subtract. We add it because in this case, when you receive your bill in the mail, they're gonna tell you this. They're gonna give you an exact table like this. They're gonna tell you what your original principal was, how much interest that you accrued, and then you're gonna get a new current balance. Okay. So in this case, my current balance and my new balance is going to be the same, right? I'm going to get a receipt in the mail that I owe 55 to 865. Okay?
I was on July, that's why I missed.
Oh, okay, I see. Okay. Now,
July, we would minus the 200 from the current balance for the new balance.
correct. Well, in this case, that would be your new principal. So first, our statement balance is now 5528.65, okay? So now that I know that amount, right? If I made a payment, so as of July, I made a payment for $200. Okay? So therefore, let's go ahead and journalize that. It's July 1st now. If I made a payment, how much is actually going to go towards my loan and how much is actually going to go towards my interest?
So interest paid or accounts payable?
This isn't an accounts payable.
Would it be a loan?
Bank loan, correct, right? We're reducing, yeah.
Right on.
Mm-hmm. We're going to do bank loan. Okay. What else?
You would debit $200, and then you put principal balance, and then interest. Correct or no?
No.
Okay.
Does that go into the checking?
We got checking. Okay, so checking is going to be down here, right? Because that's what we're paying. Okay.
Interest?
Interest, yeah. In this case, we're going to recognize it as interest expense because we're paying interest. It's an expense for borrowing money. So in this case, how much did I make a payment for?
$200.
$200, okay? Now, how much was my interest as of June?
2865.
2865, okay? So then therefore, how much money is actually my $200 payment actually going towards the principal?
$171.35.
Good, 171.35. So when we're calculating this now, we can now subtract out our new principal. So my new principal for July is going to be my current balance or my new balance, subtract out my payment of 200, right? So that's my new principal now because I made my payment, right? Because this included my interest in there, therefore this is my new principal now. So when you are dealing with compound interest, you're going to be accruing interest on top of interest. So that's where they double tap you. All right? That's something I forgot to mention when we did our lecture, right? But one thing that you need to know is the more you make more payments on, it just goes up. Basically, you're going to be accruing your interest and you're going to be multiplied interest on top of your interest. So that's one of the dangers of doing a bank loan, and that's how you get the double payment. Okay, so that could be applied to your friend, right? If your friend only made a payment, they could only pay towards the interest, but because they didn't pay the interest or They didn't pay the original loan. They're just subject to paying double on top of the interest. Okay? So if that's the case, right? My new
Slow down for a second.
mhm.
Can I see the journal for a second? Okay, I got it.
Okay. Okay. So then once again, now I have a new principal, right? Because I already made a payment of 200. So therefore, this is what I'm starting out with. But because I have to accrue the interest on July, I'm going to have to rinse and repeat everything that I just did. So in this case, the rate is going to stay the same because if you calculate it right, it's going to be the 0.0625 divided by 12. So this is going to stay the same. Excuse me. I think I have another one. Okay. So once again, there you go. I'm going to repeat the same thing over and over for every single month. Excuse me. All right. So,
75.
hold on. Okay, so then we're going to multiply it once again. You said, what did you get? 27.75? Good. All right. So then what is your new balance that your billing statement should reflect?
5,356.40.
Okay, I don't know what I did there. There you go, 5,356.40. So again, that's your current balance is going to be the same thing as your new balance. Okay. Or in this case, you're actually supposed to subtract it out there. You're right there. So let me fix that real quick. So your new balance should be your current balance minus out your payment, which then you carry it over here into your principal. That's what it is supposed to be. Sorry about that. So again, your cell reference for your principal is going to be your new balance. So that was my mistake. Sorry about that.
Right. So the current balance is
The current balance is going to be your total principal plus your interest, right? That's what you owe, and that's what the bill is going to be sent out for. Okay? Your new balance is going to be the same thing as your new principal because once you made your payment, right? So now I only owe 5,328, right? That's going to be your new principal. That's going to be carried over. Okay? So instead of having the formula in your principal, and yeah, it's just carried over.
the current balance is the same as the new balance.
No, it's different. It's your principal, it's your current balance minus your payment. That's your new balance. All right, I'm gonna put it back if you're confused by that. Okay, so your new balance is going to be
I wonder if it's just because it's in that slot above us where it makes it look like, we haven't made the payment yet.
okay. Then we'll do that. Then we'll just make it the new balance minus the the payment. There you go. Okay, and then we'll make this one same thing as that one. So therefore, your new balance is going to be the 5,000. So Nicole, just scratch that idea. Just go ahead and just revert it. So the current balance is going to be the same thing as your new balance. Okay, so your new balance, right, is going to reflect now at $5,356.40 because we decided to add the $27 of interest. Okay.
I'm completely lost now.
Scrap the idea that I told you earlier. So go back to what it was before. Because Felipe made sense.
Current balance?
Yes.
I don't understand why we'd have two slots with the same number. number.
That's why I made the mistake right there, and I told you to fix it, and then now it confused you, so I told you just leave it alone. So in this case, I made that column for specifically to subtract the payment out, but I forgot to do that. So now I just if that's the case, you could go ahead and ignore this entire column if that's what you want to do. You don't have to fill this out at all because it's not going to make any sense if you have this column here if you're just going to double up on it. So your current balance is all you need. Okay, so your current balance is all you need. And now my numbers got messed up. So here, your current balance is your, okay, so it's going to be your current balance minus out your payment. Okay, here you go. So here, we're just going to ignore the new balance. Okay, we're going to scrap that idea. So here, we have a new interest of the $27.75, right? So here your bill should be coming into the mail saying you owe me this much, okay? So it's your principal plus the interest that's calculated, okay? So then on that payment in August, we decide to pay an additional more amount. So this time we're paying $250. So how much is actually going to go to your interest and how much is actually going to go towards your bank? So in this case, it is now August 1st. Okay. Your journals should look identical to your previous ones. So every time you make a payment, it should look the same, right? A portion of the money is going to go towards your bank loan, and a portion is going to go towards your interest. And lastly, you're going to make your payment. So in this case, how much was my payment for? $250, right? What was your interest that you calculated for July?
$27.90.
You got $27.90? Okay, so we got $27.75. Okay, so can you explain, Melinda, how did you get $27.90?
Oh wait, I'm on the wrong one.
Okay. Oh, did you already go ahead?
Yeah,
Okay.
I was on the wrong one.
No worries. Okay, so $27.75. All right. So therefore, how much of your monthly payment actually went towards your actual principal?
$222.25.
Okay. So this is a perfect example of why if you pay above your minimum, or in this case, the minimum was what? I don't know. I didn't tell you what the minimum was, but in this case, the more I make a payment, the more money I'm at is actually going towards my principal. Okay, so the first time I made a low payment, I made only $200 payment. I ended up paying my interest off of roughly $30, so the rest went to my actual principal. Here I made, an increase in my payment, so therefore my principal was actually paid off a little more. So in this case, I made a payment of $250. So therefore, let's go ahead and solve for the last one. Okay. So in this case, my new principal after making my payment, right, should be $5,106.40. That's my new principal. Okay. And once again, if I'm accruing my interest for August, what's my total monthly interest?
$27.90.
Okay, I did not get that. Okay, let's do it again. It's equal round.
Oh, I know what I did wrong.
Okay. Did everybody else get?
I got 25 something, but I don't know why.
Okay. So yeah, so what did you get for your principal?
Oh, for me?
Mm-hmm.
Oh no, I think again the rates it was not rounded, they're not formulated, so I was not correct on my rate.
Okay.
Yeah, but
Okay.
yeah,
All right. So then, okay, so everybody else get 2660. Okay. So then,
33,
say that again.
5,133 for the new balance.
Good. Okay. So that's your new balance. This is what the bank is going to send you in the bill in the mail. So then this time I'm paying for my August bill, so I decided to pay $50 more. So this time I'm making a $300 payment. So now it is September 1st. Okay. And I'm making another payment. Okay, so actually, how much is actually going to go towards my loan and how much is actually going to go towards my actual interest? Right? If I made a payment of $300, how much was my interest that I calculated for August? 2660. Okay, 2660. So how much actually went towards my principal?
73 and 40 cents.
Good. 273.40. Right? Now, if you want to, once again, we already solved for the actual principal. Let me see. So here, if you want to do a quick little like overview of how much the interest is collected. So right here, we should, in grand total, should be collecting a total of $2,011.51. So I mean, if you want to do a quick math real quick here, if you take your 2011.51 and you divide it by 5, which is the years, times the 12, right? Because you're making 60 payments, okay? You should roughly get $30 of interest. But because we kept paying more into the interest instead of paying the minimum, our interest has decreased over time because we're making more like a larger payment towards towards our principal. So therefore the interest just starts to decrease after that because again, it's based off of your accumulated amount that you owe. Okay, so as we keep collecting interest, if you keep just paying the minimum, you're doubling up on your interest. So that's another rule of thumb there. But because we're making more and more aggressive payments towards our bank loan, our interest is actually decreasing. But if we just paid the minimum, you're expected to pay at least $33 of interest per month. And think about it. Multiply it by 60 payments, you racked up already your original principal that you borrowed was only $5,000, but you end up racking up an extra $2,000 worth of interest. So that's almost let me see, 1/5. That's 40% of your bank loan. You're paying 40% towards the interest. You see that? Your original loan was only for $5,000, but you're ending up paying a total of $7,000. Okay? So once again, that's just a little fun thing that just to do, just so you know for future. It's not something I'm going to be testing you on. I'm not going to test you to calculate the interest and etc. But we will be taking a look at a small example when we get to our fictitious business. So for this, all I really want you to get away from this class is just to be able to calculate the simple interest and the compounded interest, okay?
Yeah, can you lower down to the journal for a second?
Mm-hmm. Okay. So any other questions in regards to this? I think we were about to go over. Yeah, we went over time.
Is that September? Why don't I have anything for the September one? Did we do September?
Yeah, that was it. September. Yeah, well, we don't need to calculate interest because the question says you're only journalizing the first 3 payments. So we did the payment on June, payment on July, payment on August, and payment on September. I mean, if you want to do it, that's fine. It's, extra practice for you, but yes. Okay. All right. If you guys don't have any extra questions, you guys are free to go. We're going to be looking at chapter 10.3, bank reconciliation, which is actually going to be a pretty interesting section. So stay tuned and we'll revert this back tomorrow. If we do get through all of the chapter 10.3, then we'll go ahead and dive into the chapter 9 and 10 exercises.